Howdy, Jacob here. Today we're looking at Wayfair. They are in the specialty retail industry, 6.3 billion market cap on 8.2 billion enterprise value. Growth has been astronomical until recently. You actually have 3 years in a row of declining revenue, but still a good amount above their COVID levels. Margins on the gross margin side, fairly small. Operating margin side have been negative. Really, only 1 year in the last 10 years have had positive earnings. So that's going to affect their return on invested capital figures. Let's see. It's not due to any research and development. It's just a tough business to make a lot of money in. And so, um, cost of goods sold plus sales, general, and admin, you're already taking off everything that you're making on the revenue side. So on the free cash flow or balance sheet side, you got $1.3 billion in cash, 3.1 billion long-term debt, 117 million short-term debt. So that 3 billion in long-term debt is a lot of their free cash flow, but again, they don't really make a whole lot of money yet, so you're really going to have to balance out. You're really going to have to create a story here. When you don't have a lot of history, or when your history isn't necessarily how you think the future is going to look, you create a story of margins based on similar businesses and revenue growth or sector and everything. So to me, that means higher margin of safety. I might put in a 17.5 margin of safety instead of my usual 15% return that I look for. And again, that's because there's just more unknowns than a business that has had very consistent margins for a long time. And so for me, a Wayfair in the specialty retail, maybe they're making 5-10%. I think 10% with those type of gross margins is kind of pushing it. So maybe let's do a decent range here, maybe 4 and 8 on the revenue growth side. I mean, they've been declining recently. Like, can they get back to growth figures? Maybe. I don't know. From what I'm seeing, this is what I feel comfortable with. 5% revenue growth, 15 PE, price free cash flow. Share change, I mean, stock-based compensation is really a heavy amount of their cash from operations, and you're looking at about 600 million as of now, which is almost 10%. Maybe they'll offset a little bit through share repurchases, but um, to me, yeah, they're going to be issuing a bit of shares uh, through stock-based compensation. And so right now, I mean, we're saying that the company's price needs to fall 61% before you get the return we're looking for here. It's too much of a story for me right now. I mean, if you understood this type of business really well, then definitely do your deeper dive, see if they can get back to amazing revenue growth. Because I mean, what we're seeing over here is they didn't really make a whole lot of acquisitions. They just were growing like a wildfire that couldn't be contained. It was just insane. And then the last 3 years, it's gotten pretty tough to grow. I mean, I know they're way bigger now, so it's going to be tough to get 30%, 40% a year. But if you understand this business and feel confident that you can put in those double-digit revenue growth figures with decent margins, then with these types of margins, I think that maybe it could be a good return. But for me, the decline in the last 3 years, the fact that they don't make a lot of money, and to have positive free cash flow, they have to issue a lot of shares through stock-based compensation. I'm just not all about it. So either way, I hope you enjoy the video and have a great day. Thank you.